Good afternoon. It is 3 p.m. normal Saturday, and today is a very cold day in Des Moines, Iowa, in general, and a very cold day in Minnesota, but yet it is a pretty nice day here in Texas. So I am giving this webinar from Texas, Houston. This is where our branch, one of our new branch is at. It's about 2 years old branch here in Houston. The topics I'm bringing to you, and the Saturday before Saturday, we talked about move or not move, Iowa and Texas comparison. The only reason we're doing that is we want to bring to our audience a understanding of a decision-making process. So when you are considering relocating from one place to another, obviously there is reasons beyond dollars and taxes, right? Taxes should really be a side benefit. And you want to move closer to your mom, or you want to move for the significance of others, those are non-negotiable. Like you move. But when you move, after you move, those are the things can come into play, and to know what your new tax is going to be for that state is definitely helpful. It may add some excitement to your move, or maybe add a little bit of understanding that, okay, breathing the wind, you're going to pay more taxes, so what you're going to do with that, right? You know, every state has a lot of populations. California is one of our biggest states. So today's topic is between California and Texas. And people between California and Texas, my experience goes, there's a lot of people going between these two states. Maybe because the weather is comparable, so they are not challenged by a cold winter like Iowa and Minnesota. But the tax side of the world is very different. So people would move for this reason, that reason. So let's take a look at from different angles of taxes and see where we are in terms of comparing California with Texas and how that fares out for, for people who file 1040 or business people who run businesses, right? So we cover different angles. Let's go take a look. And this, before we dive into the real content, I always like to brag a little bit about our community CPA. So you can find us online. Our website address is communitycpa.com, and there you can see all of our new branches or branches that we had, and you can also become our client by going into onboard with us, and you can also make an appointment with us online. So we're trying to be a very functional and robust company where you can find answers right away, whether by emailing us, send us a note, send us a message from here, or just simply go on board with us, uploading your questions, your notices, whatever you have, and leave a note, say, hey, Ying, go ahead, tell me what I should do. So that's how we conduct our business. So the YouTube channel is really where we have all of these webinars that I'm talking about and other people do, and they're all here. So you can go to our channel. The channel name is @CommunityCPA. You subscribe to our channel. Subscribing our channel does several things for us. Number one, it gives you the immediate notifications whenever we got new video come up. You're going to get about 4 notices a week because we post 4. So we post on Tuesday, Wednesday, Thursday, and Saturday. So today is Saturday. So every Saturday you will see a little longer program which talks a little bit more. You don't see us on TikTok a lot. We occasionally we go there, because those concepts we're talking about is much larger than the TikTok can really give you. So what I would recommend folks is that if you really want to gain tax side of knowledge, our website, our webinars here on the YouTube channel is a really good resources. We even have accountant from other CPA firm. They come here to learn, then they go back to use that and use that to impress their boss. So we knew that the knowledge we have here is timely, and we do our due diligence, so our content is vetted through. It's not just something we give you without thinking or without looking. We do have our resources we rely on to get those data out for you, to get those content to you. So I would say that we did our best to give you the correct content. With that, you know that I have 2 books on internet you can buy from Amazon. I have 2 more books, 2 p.m. and 6 p.m. The PM 2 books haven't really get that done. But it's a business series where I talk about begin the business, grow the business, expand the business, retiring from the business. So the next 2 is expanding and retiring. So those are not done yet. I'll let you know when I finish that. No responsibility disclaimers. This is a free webinar. All of our webinars on our YouTube channel, all of them are free. So you can learn the knowledge from there. But just keep in mind that when you decided to use the knowledge to serve you in real way, make sure you vetted that through. And you can go on to all kind of AI models to search to see whether that is something that the AI says is good. Or you can check your friend, your brother-in-law, your mother-in-law, and to make sure that they also agree with that. You just want to do your due diligence to make sure you use the knowledge properly and correctly. All right. Overview of the considerations when you move from one place to another. So we are talking about personal income tax consideration, business income tax consideration. We talk about sales tax, property tax. We also will touch on estate inheritance tax, right? So these are those are the things really the government controls it, but you are the one that will feel it. So before you move to anywhere, of course within US, then you want to consider these 4 areas. The last bullet point is residency exit planning. This is the one that when you decided to move, are you moving on August 1st, July 1st, and when are you moving? What is the date? That is important. So you need to plan that to make sure that you exit that state properly, especially if you exit California. California is known for very specific with their residency status. So you may be part year residents of California, then there's a lot of the income that you got, it is going with you, depends on where your residence is. So that determines whether you pay taxes in California or you pay taxes in Texas. Now let's look at personal income tax. So this one straightforward, okay? And we have 2 slides here. So we have California. Of course, California is one of the states imposes, the progressive income tax system, which means their rate goes from 1% all the way to 13.3% plus 1% mental health surcharge over people who had made more than $1 million in California. So it is one of the highest progressive income tax system that California has. All right, and there is no difference in California taxes if you have capital gain or regular income. At the federal level, capital gain has this 20% cap, right? So you could, even though you are making a lot of money and you're paying top rate at the federal rate, but if it is capital gain, it capped at 20%. But in California, capital gain and regular income taxes has no difference. So they are all taxed as an ordinary income. So in terms of the deductions and the credit, the California does not really take the federal deduction credit just as it is. Some states I know are pretty uniformed with whatever federal government says. So if federal government allows the deduction of certain item, then when you do taxes, you can just take federal taxable income to the state because the state would do the same thing, will also deduct the same. So there's no delta between the federal taxes and your state federal taxable income and the state taxable income. But California is one of those states that really going through process to make changes they need to make. So they have their own rules for the itemized deduction. So they're not copying what the federal says. So just be aware of that when you move to California and you do your tax return for the first year. And I would recommend you to closely monitor the numbers that are on California tax return because they are not. You cannot copy federal taxable income to California because they are not the same type of deduction. The credit didn't really allow the same way, so just be aware of that. California generally does not impose local income taxes, not like New York, right? So, there's no local income taxes. Overall, it's the state tax. We understand every state has government, right? They go from the state, the county, the city, right? Maybe even after city, there's township. So these are all governments because they are mayors or their leaders are elected officials. So those are the government unit. They, different state has a different rules. So the California state local government do not impose income taxes. So they don't have those kind of tax burden at the different level. So California residency generally results in the higher state income taxes for the high earners. And the liquidated events also is one of the things that you will pay a lot more in California. Liquidity events are, generally speaking, are the one time. Say you sold your business. So that's a one-time event, right? And you have a large amount of K1 from your S corporation. That is a pass-through income. Those are the ones really need to be considered in California because they are taxable. So that's California. Let's look at Texas. Texas has no state personal income tax. So all the stuff we're talking about doesn't exist in Texas. So the filing is really simple. If you live in Texas as Texas residents and you only file personally on the personal tax side, you're only gonna file 1040 federal and there is no state taxes you need to worry. Right? For individuals moving from California, the elimination of the state income tax can be a material impact to your cash flow because you suddenly realize that you saved that whole bunch of tax dollars, especially if you were running at 13.3%, then, there quite a bit of money goes into the state taxes, but here in Texas, you don't. Especially for business owners, and that can be something important because your cash flow is something that you want to use for expanding your business and doing certain things. So it is quite a noticeable difference on the personal income tax side. With that, let's take a look at the strategies that from our standpoint, the part year or non-residence filing. So this is something that California will require you to file part year if you move in the middle of the year. All right? So make sure that you know how to allocate the California source of income versus other state source of income because California does good housekeeping and they know that they can get tax out of you and when you are partial year residents, right? And the stock option and, those kind of vesting event, business sales, bonus payout really is something that you need to consider strategically. Say you retired. After you retire, you want to move into Texas or Florida, right? You move and from California. So when do you cut the tie with California is very important. Are you going to plan your stock option vesting schedule? And when you sell your business, are you going to plan so that become a non-California income, so it doesn't subject to California taxes, right? So those are the things you want to consider. And we are saying that if you really are considering moving, it is so worth of your investment to hire a CPA firm to get your dollars and cents calculated based on exactly the document you have. Because without data, without a scenario, it is hard to, just say that, oh yeah, if you stay here, you pay this much taxes. If you move there, you pay much less, and how much less. Those are mathematical formulas, and it can come out easily when you have a scenario. So make sure that when you get into that kind of situation, these can be calculated out. You don't have to just, I know I will save. No, you can say that, I know I will save, I'll save this much. You can literally do that. Of course, on business side, there's also consideration as well. So we talk about a personal, pretty straightforward, right, folks? Texas goes on 0%, and California goes on 13.3% maximum. So this is where you are looking at. So you're probably just wondering, oh, yay, how could a state survive when they have issues, when they do these kind of taxes? Because nobody gonna stay in California. But you know that, and California is one of our biggest economy. So a lot of people goes to California. A lot of people do business in California. And when they are doing business in California, is a large scale business. So California has the soil to bring up business, has the population, has the mentality of the state. The state infrastructure is strong. So they can bring up big business and medium businesses. That's why Silicon Valley is there. So all of these things are important for California. And with that said, if you go look at the business side of considerations for California, and this is the picture between the business income tax of California and Texas. And I want to say that businesses grow. A lot of California headquartered business actually expanding them out to different states. So I'm pretty sure there's tax strategists behind it, and they're really figuring out how the taxable income being allocated. So allocating business income to the state where the income was generated is a super key for business income tax consideration. You could have a business in California, but all of the income is generated out of a different state, then you still have to file that state taxes because the source of the income is coming from there. So here, California has this $800 minimum annual franchise tax. That's famous, right? It doesn't matter you make money or not, and when you file company taxes, they have this $800. As long as you run business in California, the $800 will goes to you. For example, if you have a rental property in California and you are filing a partnership return in California, because the rental property is in California, so you can avoid to not pay this $800 even though you're losing money every year on your 1065 on your partnership return. Corporation income tax for California is a flat rate, 8.84% for C Corp. So we understand that, right? If you have a C corporation business, they report taxes on its own. So it's report federal taxes for 21%, then they report California taxes for 8.84%. So total is about 30%, 29.84%. That's really the total taxes. A C corporation in California pays 29.84%. So we, generally speaking, we say 30%. So that is how the corporation tax goes. on the C Corp. The pass-through entity, the S Corp, the LLC, the income, of course, get taxed with the owner. Just depends the owner where they are, right? Where is their residence state. But the S Corp and the C Corp, when they file the taxes in California, they have that $800 minimum annual franchise tax. That one is not debatable, it's just there. All right. Then with the I mentioned about dividing your income into different states. In tax world, we call that apportionment. So when you look at the total sales for your company and you do apportionment to separate them into different states. If you have employees from different states, then your salary expenses is also separated out to against that portion of income made for that state. So the market-based sourcing is California's approach. Market-based sourcing just means that California used this sourcing for service companies. Okay, so they pull remote revenue into California tax base. So what does that mean? Let's say I am an Iowa company. Let's say I provide service, consultation service to California client. So that just means that the market-based sourcing, income is coming from California because those are the people in California, business in California, and you're conducting it in California. And even though you may say that, no, I was online, but your source is coming from California. That is where the California State Franchise Board will come around and tell you that you owe California tax because your business is conducted in California. Of course, there's more details in this determination, but generally speaking, if you make money out of California base, then you're facing that business income tax. So California generally result in the higher effective state income tax for the pass-through business owners and the professional service firm because it is really scalable and you can easily provide services to California. So that is one of the reasons when you are in business and you want to be sensitive to where your revenue is generated from. Business income in Texas, no corporation tax. Taxes does not impose a traditional corporation income tax like what California does with 8.84%. There is a margin tax in Texas. It's also called franchise tax. To not be confused with the franchise taxes in California, we call it a margin tax. So this applies to most of the business entities that in Texas. Okay? No tax due threshold is up to 2.47%. This is 2026 adjusted annual number. The rate is from 0.37% to 0.75%. So this is kind of the space where when you go over that amount, it will come in as a marginal tax. With the federal tax IRC related to bonus depreciation, the Texas is accepting the deductions what the federal government does. So, for example, you bought an excavator for $250,000, and then the federal government imposed this bonus depreciation, so you can write it all off, right? So let's say your total sales is $200,000. You bought this excavator, and it's also $200,000 because you can write off 100%. So your profit is zero, right? So on federal taxes, you don't pay taxes because your profit is zero. But for California, it would not be the same because they didn't really adopt the bonus 100%. So you make $200,000 sales and your excavator can only be depreciated. Don't remember the rate, but depreciate say part of it. Then you still have taxable income. So you still be subject to your 8.84% of taxes, right? But in Texas, they go with the federal bonus depreciation. So I want to mention that because it's important. Your 2.47 million not going to come up that fast, because if you have bonus depreciation, it got your $5 million sales reduced down to 1 million, then you don't have any margin tax, right? So this is where I want to kind of make you understand how things working between the state. So you don't really need to remember everything I say here, but I want you to just get the buzzword, just kind of know, oh, okay, Texas is the same as a federal, so my margin tax is not going to come up that easily. And then if you are in California, you know that the California state didn't really adopt the same as the federal government put out, so you want to study the franchise board to see what they did and making sure that your tax software really does service for you. You know, I always say that, you know, in today's world, you know, a lot of those smaller tax shop, they were using software they bought somewhere to do taxes. A lot of them don't really understand the deep-rooted reason why things the way they are. They just run their number on the computer, hope the computer will give the right number. You know, I have seen so many heartbroken errors on the tax return. We're not talking about taxpayer overpaid $10 taxes, $50 taxes, even $5,000 taxes. You know, sorry, and you overpaid, and we're not gonna bother with changing your taxes. You go forward, don't make that mistake again. But we're talking about $1.5 million. We're talking about $150,000. So those are the mistakes. By blindly trust the software gonna do it for you, and it didn't. So knowing these things, it's just gonna give you that kind of background knowledge. So you impose that skepticism to that printed out document. Just because it's printed out so nicely doesn't mean a thing. Nicely, the AI model can do nice things for you. So it just doesn't matter. It is still come back to you to understand what you are doing and whether this makes sense to you or not. Or you can simply say that, is there any difference between the federal dollars and the state taxable income? You know, if it is not equal, can you explain to me why? Just do that with your tax preparer. You'll be so much better off, and the tax preparer will be happy too, because in case they forgot something, in case the software just immature, and then they can catch those mistakes quicker than later, right? All right. So, you know, we just say that Texas often produces a lower state-level tax burden for certain closely held businesses. Okay, depending on the structure, the revenue mix, and the compliance factors, the franchise, the margin tax compliance, Nexus planning are necessary. So, you know, it is needless to say, it is important to just know that your state taxes, how that would apply to you. Now, there's a couple of items I want to mention to you for you to review when you are dealing with your business taxes after your move. You know your business is gonna face something different because you formed your business in Iowa or in California. Now you are in Texas, and you felt like you were running your business in Texas, but your registration is still in California, still in Iowa, so you don't really know, you know, you haven't really moved your companies properly. So those are the things I want you to consider when you move. It is not about knowing your tax rate, it is also knows all the steps are finished. Nexus planning is important. Economic nexus simply means that to weigh in on where you should pay taxes. So nexus, I don't know how to translate that word into Chinese. I don't have a Chinese word for it, but in English, it is giving you that understanding and the flexibility that knowing the tax is going to be imposed on you based on a broad agreement between the state. So that's where the nexus comes in. That can trigger Texas margin tax and the sales tax obligations, and depends on the economic nexus agreement out there. Entity structure, of course, is important. If you're thinking of you're going to have a C corporation and you don't have, you have this C in Texas, you're not paying corporation taxes because you're under the margin. And then if you are in California, you have a rate. So those are the consideration is easy to draw. But when you come to the real situation, I still think that you need to bring that picture to show to your tax strategist, to have them look at that, to see where to place your payroll and where to place your workers' comp insurance and where is SOS filing at. So you want to make sure that these are properly done. I have a client who moved to Texas quite some years ago. But guess what? They have 5 employees, but they moved from Wisconsin to Texas quite some years ago. But their payroll, those employees, their 5 employees, 2 moved to Texas and 3 still stay in Wisconsin. Guess what? When they run their payroll, the 2 Texas employees, they're still running Wisconsin withholding, because they completely did not think of that. Then, of course, the employee don't make any sense. They don't understand that they shouldn't be having Wisconsin. So they were, doing tax filing, never ever bothered to file Wisconsin to get that taxes back. Because they're full-time, they're residents here in Texas, they should not be withheld with any taxes. If they did, they can get that back. So those are the things when you get involved with moving, and move it with a lot of thinking with plan, right? Here's an example. And John has an S corporation and a W-2. W-2 $150,000, S corporation $20,000, single standard deduction assumed, no material credit itemized deduction. So credit, tuition credit, R&D credit, and those are the credit the government put out in, John could have. But in here, we simplify that, we don't do it. So here is the thing. So the W-2 wages and S corporation pass-through income, which was subject to California personal tax rate, right? California personal tax rate, we already know, from 1% to 13.3%, and that's what they're going to be paying. Income is taxed at a graduated rate, of course, because they're progressive rate, and with higher marginal rate applies to that proportion of income. So that calculation, and we calculated, is between $35,000 to $45,000 tax to pay. Okay, capital structure does not change California taxation, so pass-through income is exactly the same as a regular income to be taxed. As corporation also need to file as corporate return to issue K1. That return is $800 minimum tax. So this is California, all right, and with taxes you already see. So in terms of take home, the $20,000 pass through $150,000 on the income, so they pay about $35,000 to $40,000 taxes. What about John lives in Texas? So W-2 and S corporation pass-through income is not subject to any state taxes, and no personal state income tax will be imposed. The S corporation may be subject to the margin tax. Remember that if you are over 2.4 some million, but maybe they are not, so there will be no taxes, right? So of course the difference is huge. We're talking about $35,000 to $40,000 differences on real cash. If John is Texas resident versus John is California resident. But what if John moved in the middle of the year? Then he needs to file for that year. He needs to file partial year in California, the other partial year in Texas, he does not need to file anything. So on California's tax return, it will be a final return. It will be a partial year return. All right. Now, let's look at sales tax. So, obviously, when the state don't charge income tax, it charges some other taxes to continue running the government. We believe that the government running the operation is 100% funded by the tax dollars. So if you don't get taxes on the income tax, then Texas is getting money elsewhere. So let's see where Texas is getting money from. Here is California. California's state-based rate is 7.25. So in terms of sales tax, it is actually a state rate with add-on. The add-on normally is coming from local. So it's a local government will impose add-on. The state would have a base rate there already. So like state-based rate, 7.25%. Okay, if you owe state sales tax, but you are not in any local, you're not even in California, but you're selling things to Californian, and then you have a 7.25%, and then you won't even work on the local side because you are not really situated in the local, right? The local add-ons is a combined rate. So the local add-on will take the 7.25 plus whatever, so it will give a total rate. So Los Angeles being the highest one, actually not the highest one. There are also higher ones. Los Angeles is 10.25% on sales tax. The tax basis is very broad. It's like most of the things are taxable, so you know that when you go to store buying things and you're paying taxes. The economic nexus for the threshold of sales tax is $500,000. So what that means is if a remote seller selling $500,000 and more things to California residents, then that remote seller has to impose sales tax. They don't have a choice. So that is the threshold for California. Every state is different. So I want you to be aware. Let's say you order something in Amazon, and you should be charged sales tax already because Amazon already implemented the sales tax for the sales channel and the platform. But for some of the smaller sales platform, they don't have sales tax. So you buy it, you pay it. So you sitting in California house and you bought a refrigerator of $2,000 and you didn't pay sales tax. So what the requirement of the state is that you will self-report. You need to pay use tax. So you need to go to submit the sales tax to the California state to get yourself to properly use the machine. But have I ever had a California auditor coming into your house to look at your refrigerator, ask you where you bought it? No. So on the use tax side, the state are not really into audit. Most of the state don't do it on the consumer basis, but what they do is they do it to the restaurant, to the business, the small business, because they know on your tax return how much of an asset you bought. Then they ask you to produce a receipt to show whether these assets were paid sales tax or not. So that's why when you get audited by the state for sales tax, a lot of time they ask you for fixed assets schedule. Why do they do that? What's the point? Because they want to make you pay use tax. Okay. So here, our comment to you is California use tax enforcement is aggressive. Business and individuals are often audited for untaxed out-of-state purchases. So actually, we have not come across any individual, but businesses, yes. Same with other states. We work with a lot of states. So I have not seen the state to really going on enforcement for consumer at a consumer level, but they're all at the business level. Sales tax in Texas. The state sales tax is 6.25, which compared to California, that's a 7.25. So is 1% lower on the state, right? So you see in California, the highest is 10.25, which means it's about 3% of an increase, by the local. Here in Texas, the combined average is 8.25, which is about 2%, for what is at. So for Houston, for example, is 8.25. So that is a 6.25 plus 2% local. Okay, it's also taxed broadly, and the Texas sales tax rate may be lower than some of the California locals. Although both states impose pretty heavy combined sales tax compared to other states, but still, this is the consumption placed on population. So the more people you have, the state gathers more revenue. So this is where they can let go of the income tax and come back, just simply look at the consumer basis, then getting enough revenue for running the government. So sales tax is one of the key for those states who doesn't charge income tax and to charge right here. But we also know that even though Texas don't have income tax, but their state sales taxes is also lower than California, not by much, by some. For now, I give you an example. John's household, okay, annual taxable household is 80,000. Okay, so this includes taxable things like furniture, appliance, all of these household things, and exclude groceries, some prescription medicines. Okay, so this is John, and in this example with California, the combined state local tax rate, although it varies, but let's just assume, and John has 8.5 rate on here. So this results in annual sales tax burden of 6,800 to 8,000. Okay, depends on where John is. But what about Texas? Texas is approximately 8.2. So their annual sales burden is right there, 6,560. So this gives you the understanding that in terms of sales tax, if I just compare California to Texas, and I would know that both states are fairly high and similar. Texas is slightly lower than the California. Property tax. This is an interesting topic. Every time we talk about property tax, folks think about their house. Real property tax. So property tax has two large categories. One is what I call the personal property tax. The other one is what I call the real property tax. So what is personal property tax, right? And in this property tax side, and I want to just give you my thought here. So every government need to make money. The revenue model for California is relying on income taxes. But the revenue model for Texas is relying on property tax. Did you see that? So why do I say California is not relying on property tax? California's properties are expensive. So that's kind of what you're thinking, right? Let's just look at this. We'll cover that. So I guess in this slide comes first. So this is the personal property tax. Remember I said that when we think of property tax, people think real property tax. But there is a property tax called personal. Personal property tax is tax on movable, non-real estate property, usually owned by the business. So both California taxes impose this tax, okay, on business. So the business is assessed and collected at the local level in both states. So this is not a state level tax, this is a local level tax For California, business must report and pay property tax on tangible personal property used in business, such as machinery, equipment, furniture. Inventory held for resale are generally exempted. This is California. And the tax is assessed annually by the county assessor based on the reported value of these assets. You see? So California is based on the assessed value by the assessor annually. So Texas, local tax as well. County, city, school, they're all local. They impose a property tax on tangible personal property used in business, including inventory. Hear me? The inventory held in California is generally exempted from personal property tax, but not in Texas. Okay, that includes this also includes machinery, equipment, furniture, fixture, vehicle, and things like that. Intangible property, the things that you cannot touch, is generally not taxed on sales tax, like inventions, patents, and things like that. So the tax base is determined by forms prepared by you and submitted to local assessors. See, that is not assessed annually by county assessor based on the value reported on these assets. It is actually you need to submit a form to get that assessed. So these are the different approaches, different compliance requirement, right? Real property tax in California. So there is a thing called Proposition 13. So Proposition 13 says a lot of things, which is very good for California. And number one, the rate. The tax rate cap is 1% of the property's assessed value. Assessed value low, 1%. High, 1%. Assessment increase are limited to 2% per year. Cannot increase more. Okay? This is Proposition 13. So if you say things like that, California has a good property tax policy because of Proposition 13. You'll hear people talk about that. So assessment only on changes of ownership or new construction. So what does that mean? That means if you hold, this is a real story that I see with one of our clients. Both are our clients, the seller, the buyer, both are our clients. So the seller held the property for 40 years. The property was valued so low, and the taxes was only $9,000 a year. Because California don't reassess your property until you change ownership or you have a new construction. So with that said, if you just hold it for 40 years, your property tax is peanut, $9,000. But my other client bought this property. After this property was purchased, so the reassessment come in, the taxes is $42,000 a year. Does that make sense? So this is significance of California. If you have a property in California you hold in long term, and as long as you don't change ownership, your property tax is going to be low. So this is why, we say that on the property tax side, Texas is the one that getting the money from the property. I'll tell you why in the next slide. So in California, it's a great place to hold a property for a long term, right? It's tax efficient. What about Texas? Texas assessment, they don't have Proposition 13, so they assess properties annually at a full market value. So if you have a property growing from $1 to $100, but throughout the years they are growing your assessment. So they reevaluate your property value and then give you a market value to assess your tax. The effective rates commonly is between 1.6% to 2.2%, and it just depending on local government what they decide. But generally speaking, we can take a 2% as kind of where their rate is, right? But remember, California is 1%. California is 1%, the most. Proposition 13 give a cap. You cannot go over 2%. But here, by rate is already going over 2%. So property tax often materially increase after moving to Texas. So if you got used to the taxes in California, and especially you are holding properties for a long time, and then you just bought the same property here in Texas, oh yeah, you will feel the difference, right? So now, on the homestead exemption, California owner has a limited homestead exemption for property purposes. They have a very strong, stable taxes just because they have a Proposition 13 rules, regulations governed by that, by the Proposition 13. So they have a very stable tax, property tax with the with the property owners. But the Texas homestead, it does have some exemptions based on $140,000 school expense. That is not a tax amount expansion. It is that times the assessed value. So that amount exemption if it is your homestead. So this is where this is where the difference is. But both homestead has a very strong creditor protection. So both California and Texas has a very strong creditor protections constitutionally, for both states. All right. So now let's take a look at this example I have here. So John has a 600,000 house in California. The California treatment would be property tax generally assessed approximately 1% of the assessed value. So because John just bought this one, so it's 1% of 600,000, that would be 6,000. Right? That's their taxes. Annual increase in assessed value are limited to 1 to 2%. Remember the Proposition 13 limited, you cannot increase that much. So 2% increase of 600,000, that's what? It's 612,000. Then 1%, that gives you what? $100 more taxes. So that's a pretty good property tax, right? So annual property tax approximately 6,000 to 7,000. But here in Texas, it's different. Property assessed annually at a full market value. So John bought it for 600,000, but next year the full market value may be 700,000. So it just depends, right? Effective tax rate commonly range from 1.6 to 2.2. Depends on where you have your house at. The homestead exemption is a little bit, but the result is the annual property tax is going to be like higher. You are paying at the higher end of California property tax if the house is exactly the same. All right. So that is where the property tax. When people talk about property tax to you, I want you to think about two things: personal property tax and real property tax, because they are not the same. But they all belong to property tax. They all belong to the same administrator, their local tax, their county tax. So they're the one assessing those on you. All right. Estate inheritance tax consideration. This is the simplest slice I have here because none of the state would charge the estate or inheritance tax. So you take care of the federal. So this is the federal tax, right? The federal estate exemption is $15 million per person. So if your estate just means everything you have after you die, whatever you left, your papers, your pen, your bank savings, your properties, your jewelries, add them all up. If they're under 15 million, you don't even have estate tax issue with the federal. If you don't have that issue with the federal, you don't have that issue with California state, you don't have that issue with Texas state. All right? And for Iowa, we covered that at another webinar a couple of weeks ago. So Iowa actually got rid of estate inheritance tax as well, starting from January the 1st, 2025. So Iowa now leveled up with California and Texas on the estate side. So this is where, if someone goes, oh, where should I die? Should I die in California or Texas or Iowa? I would say anywhere you want. But, you're asking me where you die, so I'm considering estate inheritance tax. But if you ask me where you live, then that's a lot more things to consider, right? So really, that's where the estate inheritance taxes, a lot of times older folks, your grandparents and people like that, they probably already considered that before they went somewhere. So just want to bring this aspect to you. Even though you are in your 20s, I want you to understand that estate inheritance tax is ultimate a place where the wealthier generation need to consider. But the good news is there's no state estate and inheritance tax in California, Texas, or in Iowa. All right. Residency exit planning is actually really critical for California. And don't tell me that you just decide to move and didn't do anything. You really need to do a lot more things. And I have a simple list for you. California audit is pretty aggressive on the residency. So residency is based on domicile and closest connections, not just days present. What they're saying is that where you have your house and what kind of connections you have, and all taking into consideration, it's not just because you didn't step a foot to California, so you are not California residents. So common audit factors including location of primary residence, family location, business operation, driver license, voter registration, social, medical, and professional relationships. Look at that. It's very broad. It is a decision checklist the California government has. If they want you to be residents, not because they just love you to be walking on their street, it's because there are tax implications when you are residents of California. All right? And then, of course, for us, when you come for checking up on our strategies, and we actually will establish clear tax domicile before major income event. We will make sure, and you actually know where you are. And if you want to go away from a major distribution event, then maybe you move to Texas, you better make your Texas the primary residence, right? And establish your domicile before you talk about anything else. You want to reduce your California ties and document your intent of moving. Avoid extended stay in California after you move. So those are the strategies to help you cut it clean and move it efficiently. And CPA strategy takeaway for a move. So we do have a couple of things we want to mention to you. So situations where Texas may be more tax effective, like for example, high personal and passive income people, liquidity event like business sales, equity compensation, things like that. Desire for improve the cash flow, or investment capabilities. Those are the reasons people thinking of moving, because they can save cash flow. Situations where California may be more tax efficient, a long-held real estate with a low assessed value, business heavily tied to California customer. It just doesn't really matter if your business is for California residents. You're just gonna be sourced in California anyway, so there is no need to even trying to think of, oh yeah, I move out of California. It doesn't matter. Your business is still tied to California. And the clients unwilling or unable to fully serve California residents, to fully cut off California residents' ties. So yeah, there are people unwilling. There are people unable to cut the tie. You know, we have a client who's elderly mom with dementia. You know people with dementia, you cannot move them around because they will, for a moment, to wake up thinking they're in the wrong place because they didn't remember they moved. So dementia patients, dementia seniors, the recommendation is that where they are, where they were, and just have them there. So one of our clients, even though he works in Nevada, but he would have to go to California so often to just be with his mom, because his mom cannot move, has to stay in California. So every time when we work on his taxes and we work on the California side, just because he really have too much ties to California, it's hard to sever that relationship. So there are reasons people cannot move, or they could move easily. Bottom line, move or not move, relocation decision must be modeled before executed. That's really important. And you want to really calculate that before you move, especially if you are a business owner, you really move because of you want to get more cash flow, and you had this general impression that Texas will do better than California. And if you do that, you need to model. You need to model your business to see whether you're really going to be better off, because the answer may not be that way. And California, it has a huge business opportunity as well. So it is not exactly the same economic environment here, Texas versus California, very different, okay? Even though Texas may result in a lower tax burden, but then again, it may not be the environment for you to survive or to thrive that same business. It really need to be studied. Desire to move, you can actually consult us and do a session with us online. This is our partners online, and you actually can book appointment with us. These are 6 of us, and to bring your practical issues to these video conference, and we give you the answer before you go. So this is the ultimate way to move smartly, tax efficiently, and give your business a chance to survive better. Not just change, but change for better if you have to. All right? And I will talk to you again next week. Tuesday is a short webinar, and we always come out with our topics pretty close to the time we are getting online, just because we want the time to give us the topic that is brought up, that is brought up by our clients or by our business line managers. So all of our talks on our webinar are coming from the need of the market we serve. So we don't really like classroom book and we just go by chapters. No, we actually, there's a lot of movement between the states right now. And there's also a lot of movement between the country right now. So in one of these webinars, we will talk about country, move or not move. So then give you, because the country side of move or not move involves immigration. So that part I would need to team up with our legal team to come up with a total picture for you. But at this time, we will focus on a couple of the states we see the most move going around. So have you understand how you should make your decision, why you make your decision. I will talk to you again. Bye bye.